This is a Mining Interactive video production.
This is mininginteractive.com. I'm your host, Denise Poole, and today we are speaking with David Skarica. How are you today?
I'm pretty good.
Pretty good.
Well, it's January and sunny in Vancouver.
It's gorgeous today.
Which is pretty rare. It's like bizarro world.
We're lucky. Now, at age 18, Dave actually became one of the youngest people on record to pass the Canadian Securities course. And also in 1999, he wrote his first book, Stock Market Panic: How to Prosper in the Coming Bear Market. Before we get started with the questions, why don't you give us a little bit about your background and tell us how your book is still relevant today?
Well, as stated, I wrote this book, I got my securities license when I was 18. And I always say, one of the youngest. I think I am the youngest because I have actually no proof.
It's an unofficial
Yeah, it's an unofficial record. Yeah, exactly. And what happened was I was a teenager. I was given a lot of reading material on the markets, and that kind of stirred my interest. So I finished high school a little early, so I decided to get my securities license. And then I do a lot of historical research, even at that age. And I started seeing similarities of what was going on in the late 90s to what happened in Japan in the late 80s, the U.S. stock market in the late 20s, gold market in the late 70s, which mean it's called what's a bubble. And a bubble is something that happens about once in a generation where stocks go totally ridiculously high to the upside and then totally collapse to the downside afterwards. So my book, Stock Market Panic, was kind of predicting that technology stocks, internet stocks, industrial stocks are not the place to be. They're going through one of these bubbles. But I think what's going to happen is going to be a shift into what's called hard assets, right? And what I meant by that is stuff that comes out of the ground: gold, oil and gas, silver, nickel, copper, etc., right? And you'd want to shift your portfolio from technology and from what I call financial assets into these hard assets. And the reason I think the book is still relevant, even though it was 8 years ago, and we've had a move in gold from that time from about $300 an ounce to $900 an ounce, and move up in other commodities, is that these cycles tend to last about 10 to 15 years, maybe even 20 years sometimes. And we're about 7 years into it. So I think it's relevant because we see now that the U.S. house market is blowing up. And I think it's relevant because I think we're midway in these trends. The gold, oil, and gas commodities still have another 5 to 10 years left in their bull market, and stocks still have another 5-10 years left in their bear market or sideways underperformance. So that's why I think the book is still relevant. So being a football guy, I think we're like middle way through the second quarter. So we're not pregame anymore, and but we still have a ways to go before the end.
Still time on the clock.
Yeah, there's still time on the clock.
Now, your expertise is in technical analysis. So with the recent volatility in the market, what are your indicators saying at the moment?
Well, it's really interesting because we're talking here today. It's Martin Luther King Day in the States, so markets are closed. But Europe and Canada and all these markets are down 3, 4, 5% today, which is that's a large move. That'd be the equivalent of the Dow Jones falling about 600 points. So I actually made my presentation here at the show yesterday and Sunday. And I made the comment, I think we're near a short-term bottom in the market. And we might have one more shakeout because my indicators are reaching extreme levels. Like, let me give you an example. There's an indicator I follow called percentage of stocks on the New York Stock Exchange trading above a moving average. A moving average is basically the average price of a stock over a specific period of days. And this indicator is actually 3 indicators: 20, 50, and 200-day moving averages. And to make a long story short, when too few stocks are trading above these moving averages, it means the market's very oversold, stocks are just getting beat up left, right, and center, and you're usually sold out and you start to rally. And I correlated these percentages with past market bottoms, 2002, 1998, the correction bottoms of the last couple of years. And anyhow, we're now reaching levels seen at those past market bottoms. And if we get another bad down day in the markets, let's say Tuesday or Wednesday, we'll probably be there. And I think we're going to have an exceptional, at least short to intermediate term buying opportunity where, let's say, for argument's sake, the Dow goes down to 11,500, 11,600, right? And right now it's about 12,000. I think it could bounce 1,000 to 1,500 points in the coming months afterwards, unless we totally just fall apart. But I don't see that happening because of these indicators.
Now, what is your short-term outlook for gold and silver and other commodities in general?
I think gold has had a huge run. Just since the summer, it's gone from 600 to about, over $900 an ounce. Today, it's down to about 860. I think we could still pull back to the 800 range. and in the short term, because we've had such a huge run, we have to consolidate these gains. But one interesting indicator I follow in gold is what's called the seasonality pattern. And the seasonalities are basically what markets do during certain times of the year. And gold has a history that it bottoms and starts going up in the fall, and then it goes up into, the spring. And right now, gold started going up actually a little earlier this year in August, and it's gone from 600 to 900, as I said. And after this short-term pullback, we should keep going up, in my opinion, into the May-June period, and possibly to 11 to 1200 in gold. Now, the gold stocks also have a certain pattern. Make a long story short, I find that from their previous low to their next high, they move about 150%. So they go up to about 2.5 times in value. And we've moved up roughly 70 to 80% from the last low. So we're about halfway in that move. And I think that we will continue to move higher into the spring. But if you own a lot of gold stocks, and especially the producing stocks, the larger companies like Agnico Eagle, Newmont Mining, etc., probably in the springtime you'd want to take some money off the table. So like a long story short term, I think we have a pullback. Intermediate term, I think we keep moving higher into the spring. And long term, I think we're probably headed towards over 1,500 an ounce or higher.
And as far as the other commodities?
I think oil is now in a trading range. I think 100 represents a lot of resistance. I just see oil kind of chopping around $80 to $90 a barrel. Silver usually moves with gold, so silver should move higher into the spring as well. And it's an interesting note on that with all this volatility in the market. I think the sign that, well, we may have a recession in the States and that may trickle over to Canada, but a sign that we're not going to totally melt down is that commodity prices like copper, nickel, all these other prices are holding in. And they're economically sensitive. And the market is a leading indicator, meaning that basically those commodities trade about 6 to 9 months or 12 months ahead of what the economy is doing. And if the global economy was going to go into a really deep recession, there would be less demand for those materials, and you would see prices of them, tapering down. And you're not seeing that at all. So that's why I think this is probably a mild recession in the U.S. and maybe a slowdown in China and India, but not like a precipice or falling off a cliff, a Wile E. Coyote.
Well, thank you so much, Dave, for speaking with us today. It was great. Loved hearing about everything you had to say. If you would like to subscribe to Dave's newsletter, you can visit his website at addictedtoprofits.net, or you can check out stockchartoftheday.com. Thank you very much once again. For mininginteractive.com, I'm Denise Poole.